China is about 15% of the world's GDP. You've got 1.3 billion people living there. It may over time become the world's largest economy, whereas the New Zealand market, sitting here in New Zealand, is less than 1%. It's about 0.2% of GDP. Very small. We tend to, we've obviously got a home country bias, but really that opportunity, I think, when you look at GDP growth and how these economies grow, that really is an opportunity, not too good to miss out on, but it is a compelling reason as to why you should invest in China, in my opinion.
So how do we go about investing in China? For most people, it feels difficult.
Yeah, look, that's right. Here we sit here. I think in a New Zealand context, the typical approach, or a approach, is looking at, say, a New Zealand company with exposure to China, which makes a lot of sense. At least you can due diligence the New Zealand company, you may know the brands. Typically that tends to be in the primary sector, so the likes of Fonterra, A2 Milk, Comvita is another one, Manuka Honey is something that there's a real demand in China. So you invest via those companies who have a large part of their earnings coming from China, and a lot of their growth to those companies is actually coming from China as well. The problem with that, though, is there are other aspects to the business that don't relate specifically to China. So you're really getting diluted exposure, whereas if you can invest directly in China, that would be more logical if that's what you wanted to achieve. So to do that, I guess you can invest in a fund manager that has exposure to China. Exchange traded funds are another product that have become far more frequently available. They offer a number of various ways to get access to China, or there's the single stock, so you can invest in the individual companies. Sitting here in New Zealand, the easiest way really is through Hong Kong. A lot of Chinese companies are listed in Hong Kong, or through the US market. There's a number of what they call ADRs, American Depository Receipts, that are Chinese companies, but they're listed in the US, and they're probably the easiest way to invest as a New Zealand-based investor, but just bearing in mind that there's obviously then exchange rate risk investing in an overseas currency.
How risky is it? Because the Chinese stock market is not like the US or the New Zealand or the Australian markets.
Yeah, well, look, that's a good point. I think also to note the Chinese domestic market is called the A-share market, and that up until quite recently has been closed for foreigners or certainly for retail investors outside of China. As an institution, you can access that market, but the A-share market has traditionally been a very retail-driven market. There's a lot of information coming and going. It can be very volatile, the moves, and that really adds to that perception around the risky aspect in investing in China. I think you take a step back, those Chinese companies that are listed in other exchanges are subject to far more comprehensive disclosure rules. All those, at least in Hong Kong and in the US, they have to disclose their reports in English. They've got relatively consistent reporting periods that they have to meet. So you get some comfort around that. But at the same time, yes, there are some risks involved. Corporate governance may not be what you sort of would expect around investing, say, with New Zealand companies, but it's not as if in other markets there can also be corporate governance issues. So I guess that comes with the territory, but at the same time, possibly the rewards may or may not outweigh the risks. Yes, there are risks, but at the same time, given that growth profile around GDP growth, a lot of the companies are growing faster than GDP. It's still a very emerging market as opposed to more developed, mature market where there's less growth. So that's really the compelling aspect.
What sectors would you look at now as being the most promising?
Look, they're doing some very exciting things. I mean, particularly say in the media space, the likes of Alibaba, Tencent. I mean, WeChat is essentially the WhatsApp of China. We're talking hundreds of millions of users. It's interesting, colleagues here use it. I mean, everybody in China has got a WeChat account, and that's effectively how they communicate. So to be able to access that via investing in Tencent, the company that owns WeChat, that's a very exciting proposition. And I think here, because you don't necessarily see the use of that as much, Often these companies are far more innovative, or surprisingly innovative, despite the fact that people might think that the Chinese internet environment is heavily regulated and heavily censored. There's actually a lot bubbling on under the surface, which seems to be underappreciated perhaps by investors. The interesting thing with Tencent, at least, they have payments. So at Chinese New Year, you're able to send red packets, which is the traditional way Chinese, particularly married couples, will give to children. You can do a virtual red packet, and the volumes of that over the Chinese New Year since they've brought that in, incredible. And the more intertwined it becomes into the psyche, it's becoming harder and harder for the smaller companies to be able to get into that. So you've really got this, what they call BAT, Baidu, Alibaba, Tencent, and they're effectively the winners that potentially will take all. And there's almost a conflict with the government, because the government can't do anything because of Facebook and Google globally. They want to foster their own giants. So, but it makes it, conversely, it makes it very hard for the number twos, number threes, number fours, and then they get taken over because these companies are growing so significantly and have the firepower. It becomes very small for the smaller players. So the level of innovation is extremely high at these companies too.